All right, so we hit this a little bit earlier in the show, Matt. I don't know if you were listening. I hope you were. Financials, materials, healthcare, sitting at all-time highs. A lot of that rotation into those other sectors is largely on confidence that the Fed's going to cut rates in September and keep cutting. How much does today's PCE report, how much does that weigh on that investor confidence? Could that actually change this rotation in any meaningful way?
Well, I'm guessing probably not, because I just don't see this number being something that's going to surprise to the upside. If that does happen, we throw a wrench into the works of this most recent rally. But I think next week's when we get this employment report, I remember last month earlier this month, I guess I should say, when we saw the most recent employment report, that really shook things up. It really raised questions about whether we're going to be able to achieve a soft landing. So I think that's going to be the more important one. But as you mentioned, some of these groups are acting really well. If we can continue to rotate, if we continue to see that rotation, that's going to be very, very bullish. But the key is going to be we've got to avoid those big cap tech names from rolling over. They've been lagging this
Matt,
past month. That's okay as long as they're still rising. If they
Matt,
roll
let me interrupt
over,
you for a second. This is an interesting thesis that you have here. I hate to interrupt you when you're getting on a roll here,
sure.
But I do want to show a chart. So since Friday, looking at tech's down about 1%. I'm looking at the equal weight up 1 and about 1/3%. So we continue to see that rotation. So I think you're about to understate this thesis. In your mind, if tech continues to decline, you think that stops the rotation? That's a little bit confusing. So kind of spell that out for me. If we continue to see pressure on tech, you think that stops the rotation into these other sectors? I don't quite understand that.
Okay, this is my thinking on this. First of all, again, this rotation that we've seen in the last couple of weeks has taken place as the tech group has underperformed. You mentioned now the Nasdaq;
Right.
it's retraced about 2/3 of its decline, where the S&P has retraced 100% of it. The thing is that especially the big cap tech names, but the tech group in general, are so highly weighted in the big averages, the Nasdaq 100 and the S&P 500. 57% of the Nasdaq, over 30% of the S&P. If those start to roll over in a significant way, instead of just lagging to the upside, that's going to pull those indices down. If the major indices are going down, I'm sorry, but investors are going to start saying, do I really want to rotate into another sector, or do I want to rotate into cash, which still pays me 5%? I just think that weighting in the tech sector will cause the rest of the market to go down. If the tech sector can continue to, certainly if it rallies nicely, that's going to help. But as long as it moves higher, people will have the confidence to be able to rotate into other groups. However, if the market's getting hit, I think you'll start seeing people moving to cash, because let's face it, the economy is starting to slow, even though a soft landing is predicted.
All right, let's talk about the economy slowing. I know you're looking at the uninversion of the yield curve. I think that's the right way to say it. You're keeping a close eye on that, and we've seen it narrow to the biggest or the most degree that we've seen in about 2 years. Also, we're looking at oil prices. So generally, when the yield curve uninverts, I hope that's the right way to say it. I'm sure I'm going to get some tweets. It can be seen as an economic indicator, but we generally don't see a recession or a quote-unquote hard landing unless oil prices start to go up. And right now, we're seeing oil prices start to go up. Is that a concern for you?
Well, it is a bit of concern. As you mentioned, the people have talked about the yield curve no longer being a good indicator for a future recession. But the real timing tool comes, and it doesn't happen immediately after, but the real timing tool is not when the yield curve inverts. It's that after it inverts, once it goes back up into positive territory. And that's what we're very, very close to that. So that will create some problems. Crude oil, that's the big issue, because we got to consider what's going on in the Middle East. That escalates very gradually, but it escalates every single week. If it does become a regional war and they close down the Strait of Hormuz, those oil prices are going to shoot straight up, and that's going to cause a big problem. But the one thing though on the positive side, I don't want to ramble on too much, but the one thing on the positive side is that when the yield curve becomes positive, that's good for the bank stocks. The regional bank stocks are highly weighted in the Russell 2000. The Russell 2000 is looking to finally outperform in a sustainable basis for the first time in a long time.